TSMC is the only foundry capable of mass-producing N3E nodes. Wall Street fears geopolitical risk. The engineering reality is an unbreakable monopoly. One buy-rated semiconductor giant is currently on a massive discount, and this call today might surprise you. This is Denver Stock Lab. TSMC just earned a 61 out of 100 by the dip. They're the only foundry shipping N3E at scale, slashing power 15% over N5 at identical clock speeds. Apple's M4 and NVIDIA's next-gen Blackwell are locked in, with wafer starts already booked through 2027. Wall Street's still pricing TSMC like a commodity play. The data teardown shows a monopoly on the only node that matters for AI's next wave. TSMC's hardware moat is widening even as the stock dips 2.11% because the transition to the N2, the 2-nanometer process node that defines the physical limit of transistor density, is currently tracking a 15% power efficiency gain that renders every existing AI accelerator obsolete. While the market fixates on a minor retreat to $395.80, the lab is focused on the shift from FinFET, the fin-shaped field effect transistor architecture used for the last decade, to nanosheet transistors, where the gate surrounds the channel on all 4 sides to eliminate subthreshold leakage. This is not a marginal upgrade. It is a fundamental re-engineering of how electrons move through silicon. At the 2 nanometers level, TSMC is integrating backside power delivery, a manufacturing technique that moves the power distribution network to the rear of the wafer to reduce IR drop, which is the loss of voltage due to the resistance of the metal interconnects. By moving the power rails away from the signal lines on the front, TSMC is solving the routing congestion that has plagued the N3E, the 3-nanometer enhanced node currently powering the highest-end mobile and AI chips. We are looking at a transistor density improvement of roughly 1.1x. But the real story is the thermal envelope. As Blackwell B200 chips push toward 1,200 watts of TDP, thermal design power, or the maximum heat a chip is rated to dissipate, the physics of air cooling are hitting a hard wall. TSMC's N2 architecture is the only path to keeping these chips from melting their own sockets. When you compare this to Intel 18A, Intel's equivalent 1.8 nanometer class node, the gap isn't just in the lithography, it is in the yield. Yield is the percentage of functional chips on a single wafer, and TSMC's history with CoWoS, chip-on-wafer-on-substrate, an advanced packaging process that allows multiple dies to be stacked on a single interposer, suggests they will maintain a 20% lead in usable output over any competitor attempting a similar leap. The current market cap of $2.1 trillion reflects a dominant position, but it fails to price in the structural bottleneck of CoWoS capacity. CoWoS is the specific flavor of advanced packaging that uses local silicon interconnects to bridge massive chiplets, and it is the single most constrained resource in the global AI supply chain. While Wall Street worries about a 2.11% price drop driven by macro inflation fears, the engineering reality is that TSMC is the sole arbiter of who gets to ship AI hardware in 2026. Every Blackwell B200 or AMD MI350X must pass through a TSMC reticle, the physical mask used to print circuits, and the current reticle limit is roughly 858 square millimeters. To go bigger, you must use chiplets, and that requires TSMC's advanced packaging. This creates a margin capture that is unprecedented in the history of semiconductors. Management's recent pivot in language isn't about slowing demand. It's about the sheer complexity of moving from N3 to N2. We are seeing the capital intensity of these nodes skyrocket because each N2 wafer requires more passes through EUV, extreme ultraviolet lithography, the high-frequency light machines used to etch the smallest features. This is why the stock is consolidating below its 20-day moving average of $399.32. The market is sensing the massive CapEx, capital expenditure, required to build out these new clean rooms, but it is missing the revenue lock-in. If you want a chip with 100 billion transistors and a sub-1000, what power profile? You have exactly one supplier on the planet. The 2.11% retreat today is a liquidity event, not a fundamental shift in the silicon landscape. The lab views the current RSI of 51.6, the relative strength index that measures the speed and change of price movements, as a reset that ignores the fact that TSMC has already secured 100% of the initial N2 capacity from its two largest customers. The engineering bottleneck is the moat, and the moat is currently impenetrable. TSMC remains the singular choke point for the entire AI economy. Quarterly financials showing modest revenue momentum for TSM. Taiwan's semiconductor manufacturing company is currently caught in a policy-driven pincer movement where a 3.64% Fed funds rate, the interest rate banks charge each other for overnight loans, provides the valuation floor, but escalating 100% tariff threats on global trade nodes create a hard ceiling that even 58.4% earnings growth cannot shatter. While the broader market sits in a state of paralysis with the SPY and QQQ at 0%, TSM is hemorrhaging 2.1% because the market has realized that silicon efficiency is no longer the primary driver of the stock. Policy friction is. We are watching the normalization of the yield curve, the difference between long-term and short-term interest rates, which currently sits at a spread of plus 0.47%. This normalization is usually a signal of economic stabilization, yet for a capital-intensive beast like TSM, the 10Y yield at 4.47% acts as a gravity well. When the cost of long-term debt remains this high, the massive capital expenditure required to build out 2 nanometers and 1.4 nanometers fabs, semiconductor fabrication plants, becomes a heavier anchor on the balance sheet. Despite a negligible 0.6% YOY CPI, Consumer Price Index, a measure of the average change in prices paid by consumers, the last mile of inflation is proving to be a test of raw economic power rather than simple math. The lab sees a clear divergence. TSM's revenue is growing at a staggering 35.1%, but management is now forced to navigate an environment where the Fed's restrictive stance is colliding with a 4.3% unemployment rate. This labor tightness increases the cost of domesticating production in Arizona, effectively taxing the very expansion meant to de-risk the company. The market is pricing in a 5.5% recession risk according to the 10Y 3M spread, a low probability that should embolden bulls, yet the looming shadow of trade war rhetoric is neutralizing the impact of these strong fundamentals. We are witnessing the end of the efficiency era and the beginning of the resiliency era, where TSM must pay a premium to exist in a fractured global market. The geopolitical reality for TSM has shifted from a theoretical risk to an active trade war tax, as the return of aggressive tariff uncertainty redefines the cost of every wafer shipped from Hsinchu. While Wall Street fixates on the AI score of 61 out of 100, the lab is focused on the weaponization of the supply chain. The recent headlines regarding trade wars and potential tariffs on global trade nodes are not mere political theater. They represent a direct threat to TSM's gross margins. When the US-China trade relationship is framed as a zero-sum competition, TSM is the most exposed entity on the planet. We are tracking a specific linguistic shift in the global narrative. The transition from export controls, government restrictions on the sale of certain technologies to specific countries, to total trade isolation. The mention of trade wars over unconventional territories like Greenland signals a new era of unpredictable protectionism that ignores traditional economic logic. TSM is the choke point. If a new administration implements sweeping tariffs, the 35.1% revenue growth we see today will be cannibalized by the cost of rerouting logistics and paying border adjustments. Furthermore, the social sentiment is turning. There is a growing political backlash against the concentration of critical infrastructure in a single geographic node. This Taiwan risk is no longer a footnote in a 10Q, the annual report providing a comprehensive summary of a company's financial performance. It is the primary reason the short float remains at 0.5% despite the massive EPS growth. Investors are not betting against the engineering, they are hedging against a map. The lab identifies the core friction as a conflict between silicon physics and sovereign borders. TSM can master the 3 nanometers N3E process, but it cannot engineer its way out of a 4.47% 10Y yield combined with a global trade environment that is increasingly hostile to the very globalization that built the semiconductor industry. The verdict is clear. TSM is an engineering masterpiece being traded as a geopolitical proxy, and until the tariff rhetoric stabilizes, the stock will continue to underperform its own internal excellence. The technicals are screaming buy, but the macro is screaming wait. TSM reported earnings per share of $22.08, beating the Wall Street estimate of $21.14 by 4.5%. A solid beat that signals strong execution. TSM is trading below its 20-day average, currently at 390. Here's the story Taiwan Semiconductor is selling you right now. AI demand is insatiable. Our 2 nanometers node is sold out for years, and we're the indispensable backbone of the semiconductor universe. Management's script is polished, the earnings call slides are immaculate, and every quarter they trot out another marquee customer. NVIDIA, Apple, AMD, grinning like a kid on Christmas morning. But let's be clear, that's the PR version. The real story is written in the numbers they hope you don't scrutinize too closely. First, insider activity. Over the last 90 days, TSM executives and directors have net bought 11,538 shares. On the surface, that sounds bullish. Insiders buying, confidence in the future, right? But here's the catch. That number is tiny relative to the company's float. We're talking about a $1.2 trillion market cap. 11,538 shares is a rounding error. And when you zoom out, the pattern is even more telling. Over the past 2 years, insider buying at TSM has been episodic. Bursts of activity after pullbacks, not sustained accumulation. That's not the behavior of executives who see a multi-year runway ahead. That's the behavior of people who know the stock is volatile and are opportunistically picking their spots. Historically, when semiconductor insiders start buying in consistent tranches, like we saw with NVIDIA in 2023, that's a signal of deep conviction. TSM's insider activity? It's more like a cautious tap on the brakes than a full-throttle green light. Now, let's talk about the language. Management loves to tout AI demand, as if it's a monolithic, ever-expanding force. But dig into the phrasing. They don't say AI demand is accelerating. They say AI demand remains strong. That's a subtle but critical shift. Remain strong is backward-looking. It's code for, we're not seeing the hockey stick growth we expected, but we're not panicking yet. And here's the kicker. When you pair that with their CapEx guidance, $32 billion to $36 billion this year, a decline from last year's $40 billion, you start to see the disconnect. If AI demand were truly exploding, CapEx would be rising, not falling. What they're really saying is, we're not overbuilding because we're not sure this AI wave is sustainable. That's not confidence. That's caution dressed up in PR gloss. Now, let's talk about the numbers that matter. Last quarter, TSM beat EPS estimates by 4.5%, $22.08 actual versus $21.14 estimated. A beat is a beat, right? Not so fast. The trend is what's alarming. That 4.5% beat is the smallest margin of outperformance in the last 5 quarters. The beats are shrinking. And here's the real red flag: R&D spend. TSM dropped $246.4 billion on R&D last year, 6.5% of revenue, up 20.7% year over year. On the surface, that sounds like a company investing aggressively in the future. But let's decode it. R&D as a percentage of revenue is rising while revenue growth is slowing. That's not a sign of efficiency. That's a sign of desperation. When revenue growth decelerates but R&D spend accelerates, it means the company is throwing money at the problem to stay ahead. And in semiconductors, that's a dangerous game. The last time we saw this pattern was with Intel in 2018, rising R&D, slowing revenue, and a stock that flatlined for years. Institutional flows tell the same story. Institutions hold 15.5% of TSM, with the top 5 funds increasing their positions. But here's the catch. Those top 5 are index funds. They're not making a bet on TSM. They're rebalancing because TSM is a massive component of the semiconductor ETFs and the S&P 500. That's not conviction. That's inertia. The real money, the hedge funds, the active managers, are quiet. They're not piling in. They're watching. And when the smart money is watching instead of buying, that's a signal. Now, let's talk about what TSM's 10Q would say if it were being brutally honest. The risk factors section would likely flag 3 things management is glossing over. First, geopolitical concentration risk. TSM manufactures 90% of its advanced nodes in Taiwan. That's not just a supply chain risk, it's an existential one. Second, customer concentration. NVIDIA alone accounts for over 20% of TSM's revenue. If NVIDIA's Blackwell ramp hits a snag, or if they decide to bring more production in-house, TSM's margins take a hit. And third, CapEx efficiency. TSM is spending billions on 2 nanometers and 1.4 nanometers nodes, but the payoff isn't guaranteed. If AI demand plateaus, or if a competitor like Intel or Samsung cracks the code on advanced packaging, TSM's CapEx becomes a liability, not an asset. So here's the lab's PR read. What management is saying is AI demand is strong, our nodes are sold out, and we're the backbone of the industry. What the lab hears is we're not sure this AI wave is sustainable. Our CapEx is declining because we're cautious, and our insiders aren't betting the farm on this stock. The PR narrative is a carefully constructed illusion. The reality? TSM is a company at a crossroads. The AI tailwinds are real, but the risks, geopolitical, competitive, and operational, are underpriced. And when the market wakes up to that, the stock won't just pull back. It'll reprice. Hard. The momentum breakdown for TSM. RSI sits at 51, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. TSMC is the only foundry on Earth capable of mass-producing the N3E, the second-generation 3-nanometer process node that offers a 15% power reduction at the same clock speed compared to N5. This hardware monopoly is the bedrock of the bull case. While the market fixates on software, the physical reality is that NVIDIA's Blackwell and AMD's Ryzen 7000 series chips cannot exist without TSMC's CoWoS. Chip-on-wafer-on-substrate, the advanced 2.5D and 3D packaging technology that allows high-bandwidth memory to sit directly next to the logic die. With a forward PE of 20.3x, you are paying a surprisingly reasonable multiple for a company that owns the literal printing press for the global AI economy. The cup and handle formation on the daily chart suggests a massive structural base is being built, and as long as the price stays above the MA50, the 50-day moving average currently sitting at $368.61. The technical trend remains decisively upward. But here is what breaks the bull thesis. The physical and geopolitical walls are closing in faster than the capacity expansions can open up. The lab is tracking a bearish momentum shift in the MACD, moving average convergence divergence, a trend-following momentum indicator that shows the relationship between 2 moving averages of a security's price. This technical decay coincides with a P/C ratio, put-to-call ratio, which measures the volume of bearish put options against bullish call options, of 1.23. The options market is explicitly betting on a pullback. Furthermore, the U.S. export controls on 5G silicon and the A16 Bionic chip are not just regulatory hurdles. They are direct hits to the utilization rates of older nodes. If U.S.-China tensions escalate further, the $368.08 support level won't just be tested, it will be vaporized. You cannot engineer your way out of a blockade, and the market is currently pricing TSMC as a pure AI play while ignoring the massive sovereign risk of its concentrated geographic footprint. The question that makes the boardroom go quiet is this. If the CHIPS Act, the U.S. federal statute providing billions in subsidies for domestic semiconductor manufacturing, successfully forces TSM to shift its leading-edge 3 nanometers production to Arizona, what happens to the gross margin when U.S. labor and utility costs are 40% higher than in Hsinchu? The lab's answer is that management is currently using geographic diversification as a PR shield to hide a structural margin compression that Wall Street has yet to model. We are seeing a pivot from revenue-centric language to operational efficiency talk because they know the U.S. fabs will be less profitable per wafer than their Taiwanese counterparts. When you move the silicon away from the specialized ecosystem of the science park, you lose the just-in-time engineering talent that keeps yields high. Management won't admit it in a press release, but the move to the US is a tax on their dominance, not an expansion of it. The lab's final verdict is a hold with a cautious AI score of 61 out of 100. We are currently stuck in no man's land between the $368.08 support and the $419.50 resistance level. Do not chase this stock until it clears the $422 mark with significant volume, as the current bearish MACD momentum suggests a retest of the 200-day moving average at $367.90 is more likely than a breakout. The options flow is leaning heavily into the $420 call strike, but the puts are outnumbering them nearly 1.2 to 1, signaling that this smart money is hedging for a drawdown. TSM is the greatest engineering firm in history, but at these levels, the geopolitical friction is starting to overheat the financial engine. Wait for the pullback to the $368 level before even considering an entry. TSM owns the future of silicon, but right now, the macro reality is a thermal throttle on the stock price. The most immediate catalyst the market is not pricing. Samsung Electronics workers are set to strike on May 21st Korean time, pending a final arbitration attempt on May 19th at 10 a.m. local time. Samsung controls roughly 30% of global DRAM production and is a critical supplier of HBM3E memory stacked inside NVIDIA Blackwell GPUs. A prolonged work stoppage at Samsung's Huizhong and Pyeongtaek fabs does not hurt TSMC directly. It accelerates the foundry war in TSMC's favor. Samsung's foundry division has been bleeding customers to TSMC for 3 consecutive years. A labor disruption now, when Samsung needs every yield point to close the process node gap, could prove decisive. This is the structural tailwind that does not appear in any of TSMC's earnings slides. TSM is trading like the undisputed leader in semiconductor revenue growth, but the market is ignoring the margin gap that could sink its premium. Let's start with the number that matters: 35.1% revenue growth. That's TSM's year-over-year top-line expansion, nearly 5x Intel's 7.2% and lapping Global Foundries' 3.1%. Samsung's 69.3% growth looks explosive, but peel back the layers. Samsung's semiconductor division is drowning in memory oversupply, dragging gross margins down to 48%. TSM's gross margin isn't disclosed here, but we know from their 10Q that it's north of 50% for advanced nodes. That's the real edge. TSM isn't just growing faster, it's growing profitably faster. Now Intel. Their 37% gross margin is a joke next to TSM's implied 50% plus. But Intel's 70.3 XP isn't a valuation. It's a bet on IDM 2.0. The market is pricing in a turnaround that hasn't materialized yet. Intel's revenue growth is anemic, and their 18A node is still a year behind schedule. TSM's N3 node is already in high-volume production, with N2 ramping in 2025. Intel's edge? Government subsidies. The CHIPS Act is throwing $8.5 billion at Intel, but subsidies don't fix yield curves. TSM's edge is execution. Samsung is the wild card. Their 69.3% revenue growth is a mirage. Memory prices collapsed in 2023, and Samsung's foundry business is a distant second to TSM. Their 48% gross margin is strong, but it's propped up by legacy nodes and memory, not leading-edge logic. TSM's foundry business is pure-play advanced nodes, no memory baggage. Samsung's edge? Vertical integration. They can bundle memory and logic, but that's a scale play, not a margin play. TSM's edge is focus. Global Foundries is the laggard. 26% gross margin, 3.1% revenue growth. They're a specialty foundry, but specialty doesn't move the needle in AI. Their 49.1 XP is a joke. TSM's implied multiple is lower, and their growth is 10x higher. Global Foundries' edge? Niche markets like RF and automotive. But AI is the growth engine, and TSM owns that race. Valuation check. TSM's P/E is not applicable, but their EV/EBITDA is 18x. Intel's 70.3x P/E is a bubble. Samsung's 19.5x P/E looks cheap, but their growth is memory-driven, not AI-driven. Global Foundries' 49.1x P/E is a value trap. TSM's multiple is justified by growth, but the market is pricing imperfection. One misstep on N2 yields, and that premium evaporates. Capital efficiency. TSM's 35.1% growth plus 50% plus gross margin is the best combo on the board. Intel's 7. TSMC's 3 nanometers yield just hit 90%. That's the signal that changes everything. Wall Street's still treating it like a CAPEX story, but this is a margin unlock. If you're not long, you're late to the party. Here's the debate. Is this rally sustainable, or is the AI demand curve already priced in? Drop your take below. No fence sitting. Remember, the lab's all about the data, not the hype. This isn't financial advice. Markets move fast. Do your own research and never bet more than you can afford to lose. Past performance? No guarantee of future results. We'll see you in the next breakdown. Stay sharp.